Welcome. In this video, we're going back to the basics of SBA 504 lending, a popular financing program that helps small businesses buy major fixed assets like owner-occupied commercial real estate and equipment. The SBA 504 loan program is great for business owners who want to buy a building, renovate a space, build a new facility, or purchase equipment. In this video, we will cover what the 504 loan is designed to do, what types of projects qualify, common benefits for both businesses and lenders, the basic eligibility rules, how the typical financing structure works, and a clear walkthrough of refinancing options. Let's start with who we are. RMI has served as a certified development company, often called a CDC, since 1982. A CDC is a nonprofit organization authorized by the SBA to help deliver SBA 504 financing. Think of a CDC as the team that helps guide the SBA portion of the transaction, coordinating documentation, eligibility requirements, and the SBA process. We're proud to be the #1 CDC in our region and ranked number 26 in the nation. Our role is to help projects move smoothly through approval, closing, and funding. This slide shows a map of the states and areas we serve. If your project is located in the highlighted area, our team can help. We are certified to do 504 loans in Missouri, Arkansas, Kansas, and 10 counties in Illinois. Now let's talk about the benefits of the 504 program. First, lower down payments. In many projects, the down payment is typically around 10%, which can be lower than conventional commercial financing. Second, fixed-rate financing. The SBA portion of a 504 loan is typically fixed rate, which can help with long-term payment stability. Third, refinancing opportunities. In certain scenarios, the 504 program can be used to refinance existing debt, sometimes with the goal of improving cash flow. Fourth, long terms. For real estate, terms can be 20 or 25 years. For equipment, terms are generally 10 years. 504 financing can help a business buy or improve major assets with less cash down and longer, more predictable payments. The 504 program also has great benefits for lenders and communities. Lower risk to the bank. In the typical structure, the bank is in the first position at about 50% loan to value. Increased lending capacity. Since the bank typically finances only the first portion, lenders can often support more deals. Supports local economic growth. The 504 program is designed to support small business expansion, job creation, and community development. So what can a 504 loan be used for? Common eligible project costs include purchasing land in a building, renovating or improving a building, new construction, purchasing equipment, refinancing in eligible cases, and certain soft costs tied to the project. The 504 loan program is meant for long-term fixed assets, not everyday operating expenses. Soft costs are project-related costs that aren't the building or the equipment, but are part of getting the project done. Examples include appraisals, environmental reports, architect and engineering costs, construction contingency, up to 10% on building costs, and interim interest during construction. These details matter because structuring soft costs correctly can reduce out-of-pocket expenses for the borrower. Contingency on equipment is not allowed. For construction projects, the appraisal needs to support the overall project cost, including finance soft costs. In many cases, including eligible soft costs is recommended because they're real project expenses that borrowers would otherwise have to pay in cash. Now, what 504 loans generally do not finance: investment properties, residential properties, working capital, inventory, nonprofits, lending companies, short-term equipment and supplies. Here are some of the eligibility requirements. The business must be for profit. The property must be owner-occupied. It must be located in the United States. Owner occupancy thresholds: 51% occupancy for an existing building, 60% occupancy for new construction, and borrowers must meet SBA requirements regarding citizenship and eligible residency status. The SBA requires that individuals involved meet good character standards. Also, anyone with 20% or more ownership typically must provide a personal guarantee. Businesses need to average less than $6.5 million in profits for the last 2 tax years. There are also size rules, like limits tied to business profits and net worth, including affiliates. The program is also tied to economic development. Generally, there's a guideline that each $90,000 of SBA financing supports one job created or retained, $140,000 per job for manufacturers. Credit not available elsewhere, meaning SBA support is intended for cases where comparable financing isn't otherwise available on reasonable terms. Some real estate projects are not eligible because they are considered passive investment projects. Examples include developers, shopping centers, apartments, land leased for cell towers, wind turbines, billboards, or solar panels. Some real estate-heavy businesses can be eligible when there are services and operations involved, such as hotels, self-storage, assisted living providing health care, and certain service-based multi-tenant models, like salons or marketplaces. The business can't just be a landlord collecting rent. There has to be an operating business model with services. Also, it's common for one company to own the real estate and lease it to the operating company. There's no overall project maximum, but the SBA portion generally has limits. Up to $5 million for most borrowers. Up to $5,500,000 for manufacturers. And up to $5,500,000 for certain energy efficiency qualifying projects. The minimum SBA 504 loan amount is typically $125,000. Here's the typical 504 loan structure. 50% bank loan first mortgage. 40% SBA 504 loan second mortgage. 10% borrower down payment. Then, depending on the situation, add 5% for startups. Add 5% for single-purpose facilities. So you may see 10%, 15%, or 20% down. Here are some different examples of the 504 loan structure. The 50-40-10 split works for an established business that has existed for 2 years. When the business is new or has a single-purpose building, the borrower may be required to put 15% down. If the business is new and has a single-purpose building, the borrower may be required to put 20% down. Here are a few more structure notes. The bank portion must generally be at least equal to the SBA debenture portion. The bank may close and start amortizing before SBA funding. Additional collateral, prepayment penalties, and swaps may be permitted. The bank rate must be reasonable, and the bank is typically in first position on project assets. Here is information on the terms of a 504 loan. Equipment is commonly a 10-year term, banks often minimum 7 years. For real estate terms are 20 or 25 years, banks often minimum 10 years. Prepayment penalties are typically 5 years for equipment. 10 years for real estate. Also, the SBA loan is often assumable, which can help in a future sale. Bridge financing may be used especially for land acquisition or construction before SBA approval. Affiliation is an SBA concept that looks at related ownership between businesses. If an applicant business owns more than 50% of a business, there is an affiliation. Also, if an individual owns 50% or more of the applicant business and also owns 50% or more of another business within the same 3-digit NAICS code, the businesses are considered affiliated. If the applicant business has no owners at 50% or more, affiliation is triggered when all individuals who each own 20% or more collectively own more than 50% of another business in the same 3-digit NAICS code. Affiliation has an impact on eligibility because it affects size standards, including the SBA's $5 million maximum. A loss to the government may still occur even if the related party is not an affiliate. For example, when they serve as a guarantor. The 504 loan program is designed to promote job creation and retention. Projects must create or retain one job per $90,000 of SBA financing, or one job per $140,000 of SBA financing for manufacturers. If a project doesn't meet job creation metrics, it can qualify under a public policy goal, which would waive the job creation threshold. Some public policy categories can qualify without job creation requirements, including veteran-owned, women-owned, minority-owned, business district revitalization, export expansion, rural development, energy efficiency. The ownership must be 51% in those categories to qualify. A second lien will be taken on the project assets. This means the lender will hold a secondary security interest in the assets tied to the project, providing additional protection in the event of default. Personal guarantees are required from all individuals who own 20% or more of the operating company or any passive concern. In addition, if a spouse's combined ownership reaches or exceeds 20%, that spouse must also provide a guarantee. In certain cases, life insurance may also be required. This applies when an individual is considered essential to the day-to-day operations or long-term success of the business. Life insurance is automatically required when an individual owns 100% of the operating company and there is a shortfall in liquidation value. Fees include items like an SBA guarantee fee of 0.50%, a CDC processing fee of 1.50%, a funding fee of 0.25%, an underwriting fee of 0.40%. These fees are part of the overall cost of accessing long-term, fixed-rate SBA-backed financing. For 504 debt refinance without expansion or cash-out, the original debt must have been used to purchase eligible fixed assets such as land, buildings, machinery, or equipment and must align with the appraised value of those assets. The bank note must be current for at least 6 months. Any deferred payments must be brought current before the debt becomes eligible. The note cannot have had any advances within the past 2 years. Payments may impact the credit decision. If a change of ownership occurred within the last 2 years, the new ownership may render the borrower ineligible, as they may be considered a new business. No cash-out is permitted beyond a 90% loan-to-value limit. At least 75% of the original debt must have been used to acquire qualified 504 fixed assets and be secured by those assets. 100% of the original debt must have been for the benefit of the business. The business must have been in operation for at least 2 years, and the note being refinanced must have been fully disbursed for a minimum of 6 months. Late payments may impact the credit decision. Whether or not cash out is included, a maximum 90% LTV must be maintained. Here are the requirements for 504 debt refinance with no expansion and with cash out. Cash out financing for eligible business expenses, payment of utilities, payroll, normal operating costs for the next 18 months. Project limited to 85% LTV based on appraisal or 80% if multiple special or limited purpose project. No more than 15% of appraised value can be used for eligible business expenses. Here are the requirements for 504 debt refinance with expansion. Eligible for refinancing, existing SBA 504 and SBA 7A loans. The refinanced amount may include fees and prepayment penalties. You cannot refinance only the third-party lender TPL loan. Both the TPL loan and the SBA 504 loan must be refinanced together. For expansion projects, refinancing can cover up to 100% of the new project costs. Any additional refinancing must be applied before financing the expansion. The debt being refinanced must have a 12-month history of current payments. 75% of the original loan proceeds must have been used for eligible 504 fixed assets and must be secured by those assets. There is no requirement that the business has been operating for 2 years. However, if viewed as a new business, the project may require an additional 15% equity injection. Check out our website at rmiinc.org for current and historical interest rates, 504 applications and success stories, and our loan calculator. If your business is in one of the orange counties, contact Mindy or Ashley. If your business is in one of the purple counties, contact Ryan or Annette. If your business is in one of the blue counties, contact Wes or Mark.